The current economic conditions have introduced a large number of new investors to the market, as we continue to witness high volatility and uncertainty in most markets. We have also seen the rise of zero-commission trading platforms, which offer significant savings to investors. With so much opportunity knocking on your door, how do you make those important first steps towards investing in the stock market? Well, in this series of videos, we will provide you with a step-by-step guide to making your first investment in the stock market. So let's commence with our introduction to investing in the stock market on today's Investment Store. Welcome to the Investment Store, the personal finance channel that reviews a diverse range of investment asset classes from stocks and ETFs through to real estate and cryptocurrencies. If you enjoyed this video, please click the like button and leave a comment. And if you like our content, then please subscribe to the channel to become part of the Investment Store community and hit the notification bell to ensure that you never miss an episode. Now with that said, let's commence with today's video. Now the first step towards making an investment in the stock market, or indeed making any type of investment, is to understand what type of investor you are first. Key things to consider include: what is your personal financial situation? What are your financial goals? And when are you aiming to retire or achieve financial freedom? Your answers to these questions will help you to decide on the investment strategy that works best for you. It's important to remember that when it comes to choosing an investment strategy, the only thing that matters is what works best for you and delivers the outcomes that you're happy with. Once you've clarified your personal goals, you're ready to move on to the next step, which is to determine your main investment approach. There are typically two types of investment approach: passive and active investing. A passive investing approach involves putting your money into an investment fund where it is typically spread across a diverse range of financial assets and securities. A fund manager will be appointed to manage your investments in exchange for a fee, and this fee will vary depending on their level of involvement in managing your money. There are generally two types of passive investment vehicles: passive funds and active funds. Please excuse the interchangeable use of the words active and passive here. Essentially, what we mean is there's a passive strategy that comprises of active funds and passive funds. An active fund is where a fund manager actively manages your account by bundling it with other investors' money and investing it in a number of financial securities like stocks, bonds, and precious metals. The fund manager of an active fund will have full autonomy on how the funds are invested, so it's important to pick a fund manager with a good track record here. Passive funds mimic the investment holdings of a particular index or commodity, such as the S&P 500 or gold, for example, and it will track this index and deliver similar results. The most common form of a passive investment fund is an exchange-traded fund or ETF. In this type of fund, your investment is not managed, meaning that the fund manager has no control over how your funds are invested. So you take full accountability in terms of the vehicle that you choose to invest in. We will be preparing a separate video that covers fund investing in more detail and shows you how you can select a managed fund that's right for you. Most people are unconscious passive investors, but probably aren't aware of it. For instance, if you have a pension plan, such as a company pension or an individual retirement account or IRA, then your pension is probably invested in these types of funds. And this leads me on to my next point. This style of investing is ideal if you lead a busy life and either don't have the time, interest, or patience to complete extensive research on companies. An active investing approach is when an investor comes up with their own investment strategy, completes their own research, and selects their own investments. An active investment approach means that you have greater control of your investments, potentially making bigger returns in the process, and only invest in the businesses that you're passionate about. The flip side to an active investing approach is that whilst passive investors spend far less time and energy making their money work for them, an active investor puts hours into researching and making the right investment decisions. Therefore, as a general rule, an active investor should aim to make a bigger return than a passive investor. Otherwise, you're probably better off putting your money into a managed fund. The following table shows the average annual return on typical passive investment vehicles like mutual funds and investment trusts. You will notice that they have an average annualized return of about 5 to 10%, and they charge fees of approximately 1%. So let's assume an average annual return of between 4 and 9%. So as an active investor, you should be aiming to achieve returns greater than 9% per annum. Now, it's important to mention that as an investor, you should not feel wedded to any particular investing approach, and it is usually wise to adopt a balance of both passive and active investments in your portfolio. As an example, at the investment store, we equally apply both active and passive investing strategies. Now, for the remainder of this video, we will look at the two main types of active investing approaches and the different personas or behaviors associated with each. The first is growth investing. Now, if you're comfortable taking risks in exchange for big returns, then growth investing could be the right strategy for you. Growth investors are attracted to companies that are likely to grow their revenue and profits at a fast rate. A good example of this are companies like Amazon, Facebook, and Google, who between them have managed to increase their revenues by over 30% per annum over the past 10 years. As growth is a main priority for these companies, they tend to reinvest their earnings in expanding their business operations and are unlikely to reward investors with dividends. As a growth investor, you should be aware of this and conscious that you're sacrificing dividends for high capital gain. Now, the pros of this approach are that growth companies can deliver big returns in a relatively short timescale. Growth investing has also outperformed all other methods of investing over the past few years. As an example, up to August 2020, growth stocks had outperformed value stocks by up to 30% on the S&P 500. On the negative side, growth investing is far riskier than value or income investing, as a company's value is based on growth projections which are often speculative and come with no guarantees. The market value can decline rapidly if the company does not sustain their expected growth targets, and this can lead to plummeting share prices. Remember Nokia and BlackBerry? Growth companies are also very expensive, typically trading at over 30 times their net income. For this reason, as a growth investor, you need to take your time to understand the business, its potential market size, and its competitive advantage or economic moat. These are essential factors that we'll be looking at later in the series. Now, at the other end of the investment spectrum is value investing. Now, if you prefer to take a patient, measured approach to building wealth, then value investing could be the right strategy for you. Value investors look for solid companies with a clear economic advantage that are trading below their fair value. Through buying these companies at a lower price, a value investor is reducing their downside risk whilst increasing their upside potential. The pros of this approach are that value investors can make significant returns at relatively low risk. Value investors also tend to combine income investing strategies with their approach, meaning that they often seek reliable dividend-paying companies that are undervalued. This is a potential jackpot, as the investor can receive dividend payments whilst they await an appreciation in the share price of the underlying asset. We should also recognize that the most successful investors over the past 50 years have been value investors. Now, the negatives with value investing are that good value opportunities don't come around often, and whilst waiting for them to arrive, you can often end up missing out on several great opportunities. Going back to our earlier example, whilst growth investors during 2020 have made gains of over 25%, a number of value investors have either made paltry gains or lost money, as a majority of old-fashioned value stocks have not performed this year. This has led many experts in the field to question whether value investing is still a viable strategy. Since 2017, growth stocks have returned a cumulative 100% return to investors. Value stocks have only managed to achieve a 15% return. Now, as we mentioned earlier about not being wedded to passive or active investing strategies, the same applies here. You should not be wedded to either growth or value investing. In fact, we also adopt both strategies at the investment store. But having said that, we're generally value investors, and we believe that there are some great value investing opportunities in the market right now. During this series of videos, we'll show you how you can find these value investing opportunities, and we'll also show you how you can employ value investing strategies whilst limiting your risk. So to recap, your investing approach depends on some of the following factors: financial goals, time horizon, risk tolerance, and availability. Availability and financial goals should determine whether you go passive or active, and time horizon and risk tolerance on whether you veer more towards growth or value investing. Now, in the next video, we'll look at how to start the active investing process by finding good companies to analyze. A question for you: what type of investing strategy suits you best? Thanks for watching. If you enjoyed this video, please leave a like and leave a comment. And if you'd like to learn more about how we analyze assets, then please subscribe to the channel and ensure that you watch the next video. We look forward to seeing you on the next video.